Silver didn't just tumble, it sent a warning through the entire financial system. Most people believe they already know why prices suddenly fell. But what if the biggest reason isn't the one dominating today's headlines? Behind this sharp decline, two powerful forces have quietly started working together. And if they continue to strengthen, silver may not be finished moving lower. The surprising part is this. The same forces pressuring silver today could soon reshape gold, inflation, interest rates, and even the decisions made by central banks around the world. So, before assuming this is just another ordinary market correction, there's something every serious investor needs to understand. Welcome to Next Alert, where we connect the dots behind the world's biggest economic stories. If you're joining our community for the first time, especially those of you who have spent years protecting your hard-earned wealth, please take a moment to subscribe. It helps you stay informed before the next major market shift arrives. And before we begin, let us know in the comments, which country are you watching from today? For months, many investors believed silver was building the foundation for another powerful rally. Demand from industry remained resilient, central banks around the world continued accumulating precious metals, and economic uncertainty showed few signs of disappearing. The broader narrative appeared supportive. Yet, within a single trading session, that confidence began to crack. Silver experienced one of its sharpest declines in weeks, catching both experienced traders and long-term investors by surprise. Headlines quickly pointed to geopolitical tensions as the obvious explanation. Markets often react emotionally when military conflicts intensify, shipping routes become vulnerable, or global supply chains appear threatened. But financial markets rarely move because of a single event alone. Beneath every major price swing lies a chain reaction that unfolds long before most people recognize what is happening. This decline was no exception. As geopolitical tensions escalated, energy markets responded immediately. Oil prices climbed as traders started pricing in the possibility of future supply disruptions. At first glance, higher oil prices may seem unrelated to silver. However, seasoned market participants understand that rising energy costs ripple through nearly every sector of the global economy. Transportation becomes more expensive, manufacturing costs increase, and businesses begin preparing for higher inflation. That is where the first warning signal emerged. Inflation has always been one of the Federal Reserve's greatest concerns. Whenever markets believe inflation could accelerate again, expectations surrounding interest rates begin to change almost instantly. Investors who only focus on silver prices often overlook this critical connection. The precious metals market does not exist in isolation. It is deeply connected to monetary policy, bond markets, currency movements, and investor expectations. Institutional investors understand this relationship exceptionally well. Before most retail investors had even finished reading the day's headlines, hedge funds, commodity desks, and large financial institutions were already recalculating their positions. Sophisticated trading models continuously monitor inflation expectations, Treasury yields, currency strength, and geopolitical developments. The moment these indicators shifted, billions of dollars began moving across financial markets. Silver quickly found itself under pressure. Unlike gold, silver occupies a unique position within the global economy. It is both a precious metal and an essential industrial material. It protects wealth during uncertain times, yet it also depends heavily on manufacturing, electronics, renewable energy, and industrial production. Because of this dual identity, silver often reacts differently than gold during periods of sudden economic uncertainty. That distinction became increasingly important as markets processed the latest developments. Instead of viewing silver solely as a safe haven asset, many institutional traders temporarily shifted their attention toward the possibility of tighter monetary policy. If higher inflation forces central banks to keep interest rates elevated for longer than expected, holding non-yielding assets like silver becomes less attractive in the short term. The market was no longer reacting only to geopolitical headlines. It was beginning to price in an entirely different financial environment. This is where many investors make a costly mistake. They assume prices move because of the news they see on television. In reality, markets often move because professional investors are reacting to what they believe will happen next, not what has already happened. And that raises a far more important question. If geopolitical tensions merely triggered the first wave of selling, what was the second force quietly building beneath the surface? More importantly, could that hidden force continue pushing silver lower, even if global tensions begin to ease? The answer may determine not only where silver goes next, but how investors should interpret every major market move in the weeks ahead. The market's biggest moves rarely begin with panic. They begin with silence. Long before television anchors start explaining why prices are falling, and well before social media fills with predictions of a crash or recovery, something much more important is already happening behind closed doors. Inside investment banks, hedge funds, pension funds, and commodity trading desks, billions of dollars begin changing direction, not because of today's headlines, but because of tomorrow's probabilities. That silent repositioning may have been the second force quietly crushing silver. While much of the financial world focused on geopolitical conflict and rising oil prices, professional investors were watching a completely different screen. Their attention was fixed on the Federal Reserve, inflation expectations, Treasury yields, and one simple question that could determine the path of every major asset class. What if interest rates stay higher for much longer than anyone expected? For precious metals, that question carries enormous weight. Unlike dividend-paying stocks or interest-bearing bonds, silver generates no income while it sits in an investment portfolio. Investors buy it because they expect its value to rise over time, or because it acts as protection against economic instability. But when markets suddenly believe that interest rates may remain elevated, the calculation begins to change. Government bonds become more attractive. Cash starts earning meaningful returns. The US dollar often strengthens. And non-yielding assets like silver suddenly face much tougher competition. This relationship has repeated itself throughout modern financial history. Every time markets dramatically revise their expectations about monetary policy, institutional investors respond with remarkable speed. They are not waiting for the Federal Reserve to officially raise or cut interest rates. They are attempting to anticipate those decisions months before they happen. That anticipation is where fortunes are made, or lost. As inflation concerns resurfaced, traders began questioning whether the Federal Reserve would truly be able to deliver the interest rate cuts many investors had been expecting. Even the possibility that policymakers could maintain a restrictive stance was enough to trigger a wave of portfolio adjustments across global markets. Those adjustments rarely happen manually. Today, much of Wall Street relies on algorithmic trading systems capable of analyzing economic data within fractions of a second. These systems monitor Treasury yields, inflation forecasts, currency movements, commodity prices, and central bank communication simultaneously. When enough signals align, computers execute thousands of trades automatically. By the time most retail investors notice silver falling, many institutional trades have already been completed. That helps explain why silver's decline sometimes appears far more aggressive than the day's news alone would justify. Yet another layer was quietly adding pressure: the US dollar. When expectations of tighter monetary policy increase, international capital often flows toward dollar-denominated assets. A stronger dollar generally makes silver more expensive for buyers using other currencies. As global purchasing power weakens, demand can soften, placing additional downward pressure on prices. It becomes a chain reaction. Higher inflation expectations push Treasury yields upward. Higher yields strengthen the dollar. A stronger dollar weighs on precious metals. Algorithmic trading amplifies the move. Institutional investors reduce exposure. Retail investors begin selling after prices have already fallen. The cycle feeds itself. History shows that some of silver's fastest corrections have occurred not because physical demand suddenly disappeared, but because financial markets rapidly repriced future economic expectations. The physical metal remained the same. Industrial demand changed very little overnight. What shifted was investor psychology, and expectations often move markets faster than reality itself. Still, one question refuses to disappear. If geopolitical tensions continue driving inflation fears while the Federal Reserve maintains a cautious stance, could these two forces reinforce each other for weeks or even months? If that happens, silver's recent decline may prove to be more than just another temporary pullback. It could become the first chapter of a much broader global economic adjustment that reaches far beyond the precious metals market. Financial markets have a habit of distracting investors. When prices fall sharply, the headlines usually focus on the event that triggered the decline. Yet experienced analysts know that the real story often lies beneath the surface. A sudden sell-off is rarely just about today's news. More often, it exposes weaknesses or strengths that have been quietly building for months. Silver's latest decline may be sending exactly that kind of message. The question is no longer why the metal fell. The more important question is what the market is actually trying to price in. To answer that, investors must look far beyond precious metals. Across the global economy, several powerful forces are beginning to collide. Energy markets remain sensitive to geopolitical developments. Governments continue carrying record levels of debt. Inflation has eased from its peaks, but it has not completely disappeared. At the same time, economic growth in many regions is slowing, creating an environment where policymakers have fewer easy choices than at any point in recent years. This combination creates uncertainty, and uncertainty forces capital to move. Large institutional investors rarely concentrate on a single market. Instead, they evaluate the entire financial landscape as one interconnected system. Every decision regarding bonds, currencies, commodities, equities, and precious metals is made within that broader framework. That is why silver cannot be analyzed in isolation. Unlike gold, silver derives a significant portion of its value from industrial activity. It plays an essential role in solar panels, electric vehicles, semiconductors, advanced medical equipment, telecommunications, and modern electronics. Every expansion in technology increases long-term demand for silver, but industrial demand follows economic growth. If manufacturers become less optimistic about future production, purchasing slows. Companies reduce inventory. New investment projects are delayed. Orders become smaller. None of these changes happen overnight. Yet financial markets begin anticipating them well before official economic reports confirm the trend. This is where today's decline becomes more intriguing. Physical silver demand has not collapsed. Mines have not suddenly flooded the market with unlimited supply. Factories have not stopped using silver. Instead, investors are attempting to determine whether the global economy is entering another period of slower growth, while inflation remains stubbornly elevated. Economists refer to this possibility as one of the most difficult environments for policymakers. Growth weakens. Prices remain high. Central banks struggle to stimulate the economy without reigniting inflation. Markets become increasingly volatile because every economic report carries greater significance than usual. For long-term investors, this creates both danger and opportunity. History shows that some of silver's strongest bull markets began immediately after periods when confidence reached its lowest point. During those moments, short-term traders focused entirely on falling prices, while patient investors concentrated on long-term fundamentals. The difference between those two groups often determines who benefits from the next major cycle. Meanwhile, central banks around the world continue making decisions that deserve careful attention. Many nations have spent the past several years increasing their exposure to tangible assets while reducing dependence on foreign currencies. Although gold has attracted most of the headlines, the broader movement reflects growing concern about long-term monetary stability. That trend should not be ignored. It suggests that governments themselves remain uncertain about the future direction of the global financial system. If confidence in traditional monetary policy weakens further, investor behavior could change rapidly. The market's current weakness may therefore represent something larger than a temporary correction. It could be part of a much broader transition as investors reassess inflation, growth, debt, and the future role of hard assets in diversified portfolios. Still, one final question remains unanswered. If today's selling pressure reflects fear rather than collapsing fundamentals, what happens when those fears eventually begin to fade? Because history has repeatedly shown that the markets creating the greatest uncertainty often become the very markets that attract the strongest wave of long-term capital once confidence starts returning. And that possibility may be far more significant than the decline investors are watching today. Every major market cycle eventually reaches a defining moment, not when prices are making headlines, not when everyone suddenly agrees on where the market is going, but when uncertainty becomes so overwhelming that most participants stop asking what comes next and begin reacting only to what has already happened. Silver may now be approaching one of those moments. The past several weeks have demonstrated how quickly confidence can change. A combination of geopolitical uncertainty, rising energy prices, shifting inflation expectations, and changing views on Federal Reserve policy has created an environment where investors are forced to reconsider assumptions they held only a short time ago. Yet history suggests that periods like these often reward preparation rather than prediction. The greatest mistake investors make during volatile markets is believing they must know exactly what will happen next. Professional investors think differently. Instead of attempting to predict a single outcome, they prepare for multiple possibilities. If inflation remains stubborn, interest rates could stay elevated for longer than expected. That would likely continue supporting Treasury yields and the US dollar while keeping pressure on precious metals in the short term. If inflation begins cooling faster than anticipated, policymakers could gradually shift toward easier monetary conditions. Such a change would likely improve the outlook for assets like silver as borrowing costs decline and investment capital searches for alternative opportunities. There is also a third possibility. Economic growth could weaken while geopolitical tensions continue disrupting energy markets and global trade. That combination would create an unusually complex environment where markets experience higher volatility across nearly every major asset class. None of these scenarios can be dismissed. That is precisely why experienced investors spend far more time monitoring economic indicators than reacting to daily price movements. Over the coming weeks, several reports deserve careful attention. Inflation data will reveal whether price pressures are easing or beginning to accelerate again. Federal Reserve speeches and policy statements may provide important clues regarding future interest rate decisions. Treasury yields will show how bond investors are interpreting those signals. The strength of the US dollar will continue influencing global commodity prices. Oil markets will remain one of the clearest indicators of geopolitical risk and inflation expectations. Finally, physical silver demand will reveal whether long-term buyers view recent weakness as a warning or as an opportunity. Each of these indicators represents one piece of a much larger puzzle. Viewed individually, they may appear insignificant. Viewed together, they begin to reveal where global capital could move next. That is why emotional investing rarely succeeds. Markets are designed to test patience. Sharp declines create fear. Rapid rallies create excitement. Both emotions encourage investors to abandon disciplined decision-making precisely when clear thinking matters most. The most successful long-term participants recognize that wealth is rarely built by reacting to every headline. It is built by understanding the broader economic forces that continue operating long after the news cycle moves on. Silver's recent decline should therefore be viewed as more than a single market event. It is a reminder that financial markets remain deeply interconnected. A conflict affecting energy supplies can influence inflation. Inflation can reshape central bank policy. Central bank policy can move bond yields. Bond yields can strengthen currencies. And together, those forces can dramatically alter the direction of precious metals. Understanding that chain reaction is far more valuable than simply knowing whether silver closed higher or lower on any given day. Because in the end, successful investors are not rewarded for following the crowd. They are rewarded for recognizing structural shifts before they become obvious. So the question is no longer whether silver has fallen. The real question is whether this decline represents the end of the story, or the beginning of the next chapter in a much larger economic cycle. Only time will provide the final answer. But history has consistently shown that those who remain informed, patient, and prepared are often the ones best positioned when the next major opportunity finally arrives. If you found this analysis valuable, let us know your perspective in the comments. Do you believe silver is entering a deeper correction? Or is this simply another temporary shakeout before the next long-term move? And if you haven't already, subscribe to Next Alert for clear, data-driven insights into the global economy, precious metals, and the financial trends shaping tomorrow's markets.